Hello everyone, my name is Wina Annisafitri and I want to present my research with the title of Market Volatility and Corporate Investment on Stock Liquidity in Emerging Market. There are 4 topics that will be discussed. First is background, second is literature review, third is methodology, and the last one is result and discussion. First is background. The background of this research is first, emerging market countries are developing rapidly and have an important role on global economic growth. Second, emerging markets are characterized by a volatile market, but with returns that can easily reach 75% per year, according to Lesman. Third, investors invest in emerging markets expecting a high rate of return because these countries have high GDP growth. Fourth, based on Figure 1, stocks in Asian emerging market countries are outperforming compared to other developed countries during the COVID-19 pandemic. The COVID-19 pandemic have greatly affected economic activity, also on prices and volatility of financial assets. Stock liquidity is essential for financial stability and economic growth, especially during extreme events. According to Kyle, stock liquidity are affected by private information and market liquidity. Private information affects the efficiency of corporate investment as a factor of investment decision, and market liquidity affects market volatility. Based on previous research, optimal corporate investment increases stock liquidity by influencing stock risk and through pricing strategies. Market volatility affects stock returns directly or indirectly through stock liquidity. Stock liquidity is the key in the effect of unexpected changes in market volatility on stock returns, according to Chong and Chuang. This research wants to examine the effect of volatility in the stock market and company activities on stock liquidity in emerging market countries. Second is literature review. This research using MSCI Emerging Market Index, which is an index created by Morgan Stanley International designed to measure the performance of the equity market in 27 emerging market countries. MSCI classifies market based on 3 criteria, which are economic development, size and liquidity, and market accessibility. Next is stock liquidity. Liquidity and stock prices are used as measure of the company's performance by the public and investors. Stock liquidity can be measured through 2 indicators, which are the percentage effective spreads and Amihut's liquidity measure, according to Dang et al. Next is market volatility. Stock price can be either higher or lower than estimated, caused by price volatility due to market movement and noise, according to Kissel. The existence of volatility can provide a risk to investment. The higher the volatility, the higher the risk. Investors will consider to invest into risky stock market with an expectation of getting reasonable returns, according to Mamta. Next is corporate investment. Corporate finance is financial decision made by corporation with 2 major categories. First is investment decision and financing decision, according to Renzetti. Investment decision related to capital budgeting, which will have implication for the company's financial position. Third is methodology. This research sample consists of 211 common stocks of companies listed in 6 countries from MSCI Emerging Market Index. This research used real GDP growth as country-specific variables, classified into 3 groups, which are high GDP growth, which is China and Indonesia, medium GDP growth, which is Taiwan and Korea, and low GDP growth, which is Brazil and Mexico. This research used proposal sampling to collect data following the criteria of Griffin et al. And Becker, Stein, and Merkel. The criteria are: first, eliminate cross-listing, duplicating, mutual fund, stocks, unit trusts, certificates, notes, right, preferred stock, and other non-common stocks. Second, shares list on the constituent index of each country during the period in 2011 and 2020. Third, shares with total assets above 100 billion. Fourth, common stocks traded only in that country using local currency. Fifth, most traded stocks. Sixth, excluded shares with too small and negative book-to-market value. And last one is exclude companies that does not provide corporate investment information. The dependent variable of this research is stock liquidity, symbolized as AMH, calculated using logarithm from Amihud. There are two independent variables of this research. First is corporate investment, symbolized as CI, using the corporate capital expenditure. Second is market volatility, symbolized as MV, measured by a standard deviation of the average value of market returns. There are two control variables of this research. First is size, measured by logs of the company's market capitalization, and second is risk, using the company's debt to equity ratio. The COV is dummy variables for COVID-19, where D equals 1 is before COVID-19 pandemic in 2011 until 2019, and D equals 0 is during the pandemic in 2020. Fourth is result and discussion. First one is simultaneous analysis, which is done in 6 emerging market countries simultaneously. Based on panel EGLS regression in emerging market countries, the results are corporate investment has a significant negative effect on stock liquidity, and market volatility has no significant effect on stock liquidity. The curve shows positive result, which shows better data before the COVID-19 period in 2011 until 2019. Next is partial analysis, which is done in each of 6 emerging market countries. Based on panel EGLS regression in high GDP growth countries, in China, corporate investment has a significant positive effect on stock liquidity, and market volatility has a significant negative effect on stock liquidity. The curve shows positive result, which shows better result in period before the COVID-19 pandemic in 2011 until 2019. In Indonesia, corporate investment has no significant effect on stock liquidity, and market volatility has significant negative effect on stock liquidity. The curve shows positive result, which shows better data in period before the COVID-19 pandemic in 2011 and 2019. Next, based on panel EGLS regression in medium GDP growth country, in Taiwan, corporate investment has a significant negative effect on stock liquidity, and market volatility has no significant effect on stock liquidity. The curve shows positive result, which shows better data in the period before COVID-19 in 2011 until 2019. In Korea, corporate investment has a significant positive effect on stock liquidity, and market volatility shows a significant negative effect on stock liquidity. However, in Korea has small R-square of only 2% because the company is a conglomerate or chaebol where ownership and control are dominated by family owners. The curve shows negative result, which shows better data in the COVID-19 period in 2020. Next, based on panel EGLS regression in low GDP growth country, in Brazil, corporate investment has no significant effect on stock liquidity. Market volatility has a significant positive effect on stock liquidity, and the curve shows positive result, which shows better data in the period before COVID-19 in 2011 until 2019. In Mexico, corporate investment has a significant negative effect on stock liquidity. Market volatility has a significant positive effect on stock liquidity, and the curve shows negative result, which shows better data in the COVID-19 period in 2020. The conclusion are, first, corporate investment shows negative significant effect on stock liquidity in 6 emerging market countries, which conclude that the investment made by the company shows a negative signal to stock liquidity in emerging market countries. Market volatility does not have an effect on stock liquidity in emerging market. This due to the existence of private information or information asymmetry between the company and the market, which is still high in most of emerging market countries. Korea has small R-square of only 2% due to companies that are in the form of conglomerates or chaebol, where ownership and control are dominated by family owners. These organizations have a unique and complex organizational structure that makes it difficult for outside investors to monitor the company's internal cash, so the investor delay reaction to earning news from chaebol companies, according to Choi et al. This research shows different results in each country because each market has different characteristics in stock market structure. First, in China and Korea, corporate investment shows positive significant effect on stock liquidity, which concludes that investment made by the companies give a positive signal. In Mexico and Taiwan, corporate investment shows negative significant effect on stock liquidity, which conclude that investment made by the companies do not give positive signal to stock. This is due to the existence of private information on information asymmetry between the company and the market. In Indonesia and Brazil, do not show significant effect. It is caused by information asymmetry that still hide in emerging market countries. These results are in accordance with Lang that stock liquidity is related to information transparency. The smaller information asymmetry between the company and the market will increase stock liquidity, according to Jung. Next, market volatility on stock liquidity. First, market volatility in Brazil and Mexico shows a positive significant effect on stock liquidity, indicates that investors as a risk taker tend to sell or buy stocks in high volatile market, which increase stock liquidity. Second, in China, Indonesia and Korea, market volatility shows a negative significant effect on stock liquidity. Negative effect indicates that in the high volatile market, investors are much more vulnerable to price fluctuation, thus they are more likely to hold their shares and reducing stock liquidity. Taiwan do not show significant effect due to the existence of private information or information asymmetry between the company and the market. Most countries shows positive result indicating better result before the COVID pandemic occurred in the period of 2011 until 2019. However, in Korea and Mexico, it shows negative result indicating that company activities in these countries actually increased during the COVID pandemic period. In Mexico, the companies are mostly non-cyclical consumer companies such as food processing, personal products, food retailing and distribution, and several technology companies. In Korea, some of the companies are technology companies, consumer non-cyclicals, utilities, and chemical industries. Those type of companies are most likely to survive during the pandemic. However, further research is needed to determine whether the type of industry affects stock liquidity, especially during the COVID-19 pandemic. That's all my presentation, and thank you.